Well, UK government borrowing skyrocketed to more than £62 billion in April, with a cash outflow of more than £102 billion, which is twice the level of a year ago. And that's just 1 month. In the US, they've acted on a $2.2 trillion stimulus package. That amounts to half the total federal spending last year. And let's assume that more is on the way. But how will it all be paid for? If governments won't simply write it off, they'll have to pay it back. And that could mean more austerity. And what of emerging markets where raising debt isn't so easily done? Do they just have to watch as their economies crumble? Are we going to see a wider social divide than ever coming out of COVID-19? I'm Phil Dobbie. We'll look at that today on the Debunking Economics podcast with Professor Steve Keen. Welcome along. So, Steve, let's assume that modern monetary theory isn't put into practice at the end of this pandemic crisis. That central banks use quantitative easing to pick up the debt that bond markets might not be so ready to buy into, at least not without the price falling. And that's the key issue, isn't it? You know, to keep interest rates low, central banks are going to have to keep on holding onto that government debt for quite some time. Otherwise, on the open market, we're going to see bond prices fall, yields would rise, and it would get out of kilter with the official interest rate. So that sort of means we're going to be stuck with quantitative easing for quite a long time, aren't we, to pay for this whole thing?
Well, I mean, what you're actually talking about is the government buying lots of bonds. Quantitative easing is buying bonds off the financial sector, which drives up the price and drives down the interest rate. So, and to actually have that happen, what you've got to have is the Treasury issuing lots of bonds so that they can be bought by the central bank. And
that's happening. Trillions of dollars. And they obviously want the interest rate to be low because they if there's a lot of government debt, they want it to be at a low interest rate. And similarly for everybody else who's had to borrow through this crisis, everybody is unified in wanting a low interest rate right now.
Yeah, well, I think, and that's certainly going to be. I mean, I think it's going to happen anyway. The interest rates are already hitting negative levels. People are looking for safe havens for their money, and not people. Financial institutions are looking for low volatility, fairly reliable, expect to get the money paid back assets right now. So they're bidding up the cost of price of government bonds, which drives down the interest rate. But the intriguing thing I'm looking at, actually, we're talking about how are you going to pay for the coronavirus later? I think the real danger is how's the private sector going to pay for the debts it runs up during the coronavirus? And there's quite a remarkable piece of data on that front. Which is a weekly data series from the St. Louis Fred, with their wonderful Fred database. Its abbreviation, which is easy to say, is TOTCI, T-O-T-C-I. Think Tootsie. So TOTCI, T-O-T-C-I, commercial and industrial loans, all commercial banks. It's a weekly series. And it just shows you what's actually probably happening right now. But nobody, I think you have to agree, unless you're running a company trying to produce vaccines, you're not going to trying to borrow money and do a sales pitch to the bank about how it's going to be a great return on their debt. This is firms having to borrow because they simply haven't got the cash flow coming in. So they're basically effectively waking up their overdrafts. Okay, this series peaked at was $2.4 trillion just before the coronavirus crisis began. So if you look at January, let's say February 12, 2.357 trillion. It is now 3.079. In other words, it's jumped by about $800 billion in a matter of a week, a matter of a month. And that's just the level of debt that firms are running up to be able to continue operating right now. So that's the real how do we pay for it, is how does the commercial sector survive the impact on its cash flows of the coronavirus.
Well, and of course, we've seen central banks and governments getting into that as well by saying, well, OK, we are going to, for example, buy more corporate bonds now, as well as government bonds, or we will offer very low interest rates or interest rate holidays to try and extend loans. But obviously, that's not a 1 year commitment, is it? That's if you look at how they're paying off government debt, then that's 10, 20, 30 years. perhaps they need to do the same thing for corporate debt as well. In that case,
I think we're going to. The term is 20 or 30 years, but you can buy a 20 or 30 year bond and sell it the next minute. So it's not a question of the term. It's the bond itself doesn't matter. It doesn't care how long you actually hang on to it. Often these things are held for matters of days when they've got dates of 30 years. But if you do, if you look what's happening, in terms of excess reserves, for example, there's just as there is for commercial debt, there's just a gigantic explosion in excess reserves. And again, the coronavirus has reversed the reversal that the central banks are trying to do by quantitative tightening. So if you go back to July 30th of 2014, that's when the excess reserves in the American system peaked at 2.7 trillion. During what they call quantitative tightening, they got it down to a low in September of last year of 1.3 trillion. It has now gone up to unprecedented level, everything is unprecedented these days, of 3.2 trillion. So it's pretty much doubled.
And and that's just possibly just the start. The Democrats are trying to get another $3 trillion of government spending. So there's going to be even more bonds, even more debt issued onto the market. But this time, the QE that is needed to try and keep those interest rates low, that's going to be around. They're not going to be able to get out of that in a hurry because we're now talking about such unprecedented levels. They can't unwind that in a hurry. This is going to be with us for years, isn't it?
Oh, yeah. And again, the same thing applied to QE itself because if you look back and see when did the level of excess reserves explode, it was when Bernanke started to take his own research seriously, having a level of reserves basically flatline at really just $1 billion, $1 or $2 billion. In 1 week, he increased it to $600 billion. And in 1 month to $800 billion. That was back in 2009. It peaked 5 years later in 2014. And then they began the unwind process, which finished in 2020. Bang, we're back up again. So you see a data line which literally is a flat line pretty much at zero at the resolution of the graph for 30 years, and then bang, over a 5-year period rising. I think a similar thing is we can expect this time around. It'll be years where the government is simply having, whether it wants to or not, having to issue more bonds, having to finance its spending being far greater than its taxation revenues, and therefore running up the government debt side of the balance sheet and freaking out all the deficit hawks.
But America can get away with this, can't it? More than other parts of the world. So we'll look at those other parts of the world in a second. But if QE is going to be around for a while, and it's going to, it's not going to be taken off the balance sheet at the central bank for quite some time. The argument in normal times, we're in deflationary times now, of course, because of the economic shock. But normally you'd say, well, okay, if the central bank is expanding the money supply so much, then that would be inflationary. But that's not happening. So then that does raise the question, given that is seen as the only side effect of modern monetary theory, and that's not going to happen. Why not have modern monetary theory? What really is the difference between a long-term QE program, maybe 10 years, versus modern monetary theory where the government is in effect borrowing and just not paying it back?
Well, as people, as proponents say, and I agree with them, it's not a theory. It's a description of what actually happens right now, and then says what you should do given that description. But we are.
Well, except there is the difference, though, isn't there? Because with modern monetary theory, you expect to wind back QE. With MMT, you're not. It's in effect what QE is happening, but without the winding back of QE later down the track.
You don't really need it. It's a question of you finding a more appropriate word than debt to describe what the government accumulates on one side, because you're basically telling people we want you to take our money so you can go and spend it, and at the same time we've got to balance our books by saying, well, let's sell you our debt as well, and we're going to hang on to the debt. You get a rising the assets and liabilities side rise at the same time.
And there is so much more to discuss, and you can hear it all in the full version of this podcast. To hear that, you need to become a subscriber. Go to debunkingeconomics.com or become a supporter of Steve Keen on Patreon. Go to patreon.com/Prof Steve Keen. And if you pledge $10 or more support for each month, then you'll get access to this and all the other podcasts in this series. That's it for now, though. I'm Phil Dobbie. He's Steve Keen. Back again with another one fairly soon. Thanks for listening.